Risk-taking has been all the rage in financial markets since the Federal Reserve halted interest rate rises at the end of last year. U.S. stocks are back near record highs, and investors are piling into low-rated corporate bonds for a little extra risk compensation. The rebound in sentiment on Wall Street may be welcomed by President Donald Trump. After last year's stock market rout, Mr. Trump has been pressing for the Fed to cut interest rates, complaining that even a pause at current levels would be a mistake. If anything, the stock market's pause in interest rate hikes makes a Fed rate cut less likely. That, coupled with strong recent retail and export data, has eased fears of a sharp slowdown and further weakened the case for rate cuts. Investors have at least got the message. They had expected the Fed to cut interest rates later this year, but now see only a 50-50 chance that the central bank will do so by early 2020. Some analysts said financial market conditions proved the Fed was right to raise interest rates last year, keeping the economy growing while reining in risks. Cutting rates at this stage would only create problems. Critics of the Fed, President Trump, White House National Economic Council Director Larry Kudlow and potential Fed Governor nominee Stephen Moore, have argued that a rate cut would accelerate economic growth in line with Trump's economic plans. They argue that, with low inflation risks, central banks need not ensure that inflation risks are contained by keeping interest rates on hold. Their analysis ignores the financial stability concerns that have been woven into the Fed's decisions since the 2007–2009 financial crisis. Mr. Mann was speaking at a conference honoring economist Hyman Minsky. Minsky has explored how excess finance developed during the boom and was unleashed in disastrous ways. The recession of a decade ago showed just how damaging this dynamic can be to the real economy. Maintaining financial stability is not the formal responsibility of the Fed. According to the legislation of Congress, the two major goals of the Fed are to ensure full employment and price stability. But since the crisis, the Fed has concluded that financial market stability is necessary to achieve the other two goals. That does not mean the end of volatility or guaranteed profits, but modest pricing of risk and the need to keep leverage, that is, investing with borrowed money, within safe limits. That is why policymakers like Boston Fed President Scott Rosengren, who is focused on job creation, have at times taken a hawkish stance in favor of higher interest rates. Some, including him, have said it is better for workers to take a little risk of higher unemployment in the short term than to let the market overinflate and burst. In recent comments, Mr. Rosengren noted that the market was relatively comfortable. That is not enough to warrant a rate increase, he said, but it is also by no means in favor of a cut. In general, Fed officials, including Chairman Powell, see financial risks as manageable, and policymakers attribute this to the rate hikes so far. Rosengren argued that the current state of financial markets requires the Fed to manage. The appropriate course of action is to leave interest rates unchanged.